this lecture, I will be focusing on some aspects such as asset, liabilities, and equity. These are very important point in accounting, especially in accounting, because the accounting system, the accounting procedures actually depends on these three things. 1494, in the year 1494, Luca Pacioli was a mathematician, Italian mathematician, who actually introduced the concept of the accounting equation. In the accounting equation, there are three things. One is asset, another is a liability, and the third one is equity. So in this lecture, I will try to clarify the concept of asset, the concept of liability, and the concept of equity. So, what is the asset? Asset is nothing but some, as far as the IFRS, International Financial Reporting Standards, asset is a something that is controlled by the entity. It is resources. Assets are resources, and that are controlled by the entity as a result of past event. As a result of past event. So some resource generated by the past event and controlled by the entity is the asset. So the resource here, the point is not only the simple resource, it is the economic resource. What does the economic resource means? Economic resource means the resource generates revenue. When the resources generate revenue, then that resources can be considered as economic resources. So this is the asset. So there are assets can be understood from two point of view, from the time point of view and from another point of view, that is called the if the asset is whether the asset is tangible or untangible. So if we consider the asset, then first there is one thing that is called the short-term asset, and there is on the basis of the time. So short-term asset, and there is long-term asset, and current asset and non-current asset, tangible asset and intangible asset. So look at this here. Assets, here is some names of the assets: cash at hand, inventory, account receivable, prepayment, investment, goodwill, patents, copyright. Okay, these are the assets. And here, which one are the intangible assets? Here, goodwill, patents, and copyrights are the intangible assets. So, so current asset and the current asset and non-current asset. Current asset is cashable, or it can be converted into cash within within a year, within 12 months. Okay, and it is expected to be converted in 12 months. So these type of assets are called the current assets. If the assets are non-current, then these are the fixed assets that cannot be expected to be converted within 12 months, more than 12 months. So non-current asset, fixed assets. And in touchable assets, there are intangible and tangible assets. And tangible assets can be, it is very easy to understand. It can be touched. The assets that can be touched is called the tangible assets. On the other hand, intangible assets does not have any physical existence. The intangible assets does not have any book value. Does not have any book value. Sometimes the goodwill or the personality of a fund manager is very good. In that case, even the even that thing is good. Stop. So, intangible assets, I have mentioned that the intangible assets does not have any physical existence and does not have any book value. Book value means the present value of the asset minus the liabilities of the company. So the difference between the present asset value and the liabilities of the company is the book value. So in case of intangible asset, there is no book value. So now there is another term that is called the liabilities. So what is the liabilities? Liabilities actually, as far as the IFRS, it is the obligation. It is the obligation of the entity. It is the obligation of the entity. Obligation for what? Obligation for returning the economic resources. So the present obligation of the entity as a result of the past event is called the liabilities. So now liabilities, there are different types of liabilities. Here I have mentioned the taxes payable, long-term debt, and bank overdraft. Okay, there are others examples or types of the liabilities, and there is another important, that is contingent liabilities. What is the contingent liabilities? Contingent liabilities are the liabilities which are dependent on the future uncertainty, dependent on the future uncertainty. That is the uncertain future event. That is the uncertain future event. So this is the contingent liabilities, and that contingent liabilities actually you can have an example such as the warranty, such as the bank guarantee. So these are the things. Suppose against the company there is a lawsuit, and the lawsuit was not settled down. So in the future, what type of how much amount will be paid out for the settlement, or to solve the lawsuit. So so this type of liabilities are the this type of liabilities mm, are the contingent liabilities. Okay, the equity. So what is the equity? As far as the IFR is, the equity is the residual interest in the asset, residual interest in the assets of the entity after deducting all the liabilities. After deducting all the liabilities. So, if you if you have the understanding about the accounting equation, then you have found that asset equal to liabilities plus equity. And and if we subtract the liability from the asset, that is here the residual interest in the asset, residual interest in the asset, that is the asset minus liabilities, and this asset minus liabilities is the equity. So so now there are some features of the equity. For example, there is a business, and there is $1,000 dollar 1,000 is the capital, and owned by the owner of the owner of the business. So here the equity is $1,000, and this equity, this equity have some features. And what are the features of the equity? So equity is the assets minus liabilities, and ordinary shares, preference share, and accumulated retained earnings. So what is the preference share? So preference share is nothing but the usually the preference shares actually is such types of shares that have ranked ranked over the ordinary shares in terms of the dividend, in terms of the dividends. So if there are two shares, one is the preferred share and one is the ordinary share, then the dividend will be paid to the preferred share. If there is a preference is concerned. So here is the difference. But preference shareholder does not have any control or voting rights, does not have any voting rights in the company. And this is the preference share. Now there is another term, this is accumulated retained earnings. So what is the retained earnings? Retained earnings are the profits. Retained earnings are the profits that are held in the business for the future purposes. For the future purposes. This is the retained earnings are the profits. It is the profits, and that profits are held for the future purposes. So this is the understanding of the equity. So so if we wrap up in such a way that the asset, liability, and equity, then according to the IFRS, the asset is the economic resources controlled by the entity as a result of the past event. This is the asset. Okay. And liabilities is nothing but the present obligations, present obligation for economic for transactions of economic resources, for transferring the economic resources, as the result of the past event. Okay. And what is the equity? The equity is as far as the IFRS is nothing but the residual interest in the assets of the entity after deducting all the liabilities. So these are the three important things that we have discussed in my accounting series, and these three things will be very useful when we will be discussing about the accounting equation. Okay, thank you.